Good morning, and welcome to another edition of Saturday Morning Coffee Talk. The S&P 500 just hit another all-time high. Anytime this happens, we get the same question. Should we sell? Should we take some profits now, sit on the sidelines, and put our money in when the market's low so we don't have to experience a downturn in the interim? Well, today we're going to take a look under the hood of what happens when the S&P hits all-time highs, and we're also going to look at how to best position ourselves today for our long-term plan going forward. So again, the market just reached another all-time high. This marks the 26th time the S&P 500 has hit an all-time high this year alone. This sparks the narrative of a crash is coming. Stocks are expensive. This is like 2000 all over again. And it always is followed by the same question: should we sell? Well, I'm here to tell you that the problem isn't that the market's high, it's thinking that you know what's going to happen next. So let's take a lesson out of the history books. The market can be expensive and still go higher. This is a key thing I want you to remember. This looks all the way back to 1950, and it gives you the all-time highs by decade. Now, in 75 years of the market, from 1950 to 2025, we've reached all-time highs in the S&P 500 1,325 times. On average, that's about 17 times a year. Now, there's obviously things going on in the world, geopolitical events, inflation, interest rates, you name it. There's always a reason to be nervous about the markets. But just because the markets are at an all-time high is not necessarily a reason to be running for the hills. And why should we not do that? Well, let's take a look at this chart from 1979 to 2026. Now, if you miss just the 50 best days in the market, mind you, this is 50 days out of nearly 17,000. If you miss just the 50 best days, your $10,000 would have grown to $148,000. Now, if you stayed invested that entire time, you would have had over $2.2 million. So instead of trying to time the market, it's much more important to have a long-term plan that fits your goals. And keep in mind, market risk is not always financial plan risk. It depends on your situation. Two different people can have very different outcomes in a market decline. Take person one, for example. They don't have a ton of money, they don't have any liquidity, all their money's in the market, and they have no financial plan, and they need this money a year from now. Well, if the market drops 20%, that's going to hurt them significantly more than someone who has a plan, has income figured out, and they can weather that 20% decline and have time for the money to grow back before they have to reach into the proverbial piggy bank. So the goal isn't to build a portfolio that never goes down. The goal is to build a financial plan that can last and withstand when the market eventually does. It's no secret that at some point the market will go down, so having that plan in place is key to reach your long-term goals. So what can we be doing now to make sure that we're handling this correctly? Well, one, make sure that you have a financial plan and your portfolio is aligned with that plan for your long-term or short-term goals. Two, ask yourself, when do you actually need the money? And three, as hard as it is to do, you have to take emotions out of it. You have to ask yourself, if I lost this money, would I be okay long term? And that's what we're all about here at Retirement Solutions, is building those plans that last. Truthfully, I don't know where the market is going to go in the next month, but neither does anybody else. But what we can control is how prepared our financial plan is when the market eventually does go down. We're not here to predict the market. We're here to plan for the future. Have a happy Saturday.